This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 338 was recorded on August 25th, 2022. I'm Erik Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Santiago Capital founder Brent Johnson is back as this week's feature interview guest. Brent and I will take a deep dive on the U.S. dollar, why it didn't crash the way so many people predicted, why it's been so strong, and why Brent says that strength is set to continue. Then be sure to stay tuned for our Postgame segment when Patrick's chart deck will be titled Talking Charts.
And I'm Patrick Ceresna. Erik, let's dive right into this S&P 500. I mean, after a solid almost 2 months of strength off of the June low, it was a relentless rally that was very overbought on the short term. And finally took a breather. I mean, we took about 150 points off of the top. But I guess the question on everyone's mind is: it something more to it? Is it just a market pullback, or is this the beginning of another bear market leg? Well, what's your take on the markets, and what are you thinking?
Well, it's all been pretty predictable so far. As I said last week, we were just hitting the 200-day moving average, a major resistance level. That proved to offer some resistance. We saw a pullback. So is what we're seeing now a pullback before a move higher above the 200-day moving average? Or is it rolling over to move down toward new cycle lows? Well, one of those things is happening. It just don't know which one yet. We'll find out. I'm watching to see. I'm leaning toward maybe this market's still trying to push higher. It doesn't make any sense to me, but we'll see what happens.
All right, Erik, let's move on to that U.S. dollar index. We put in that July high, started a pullback. Here, the U.S. dollar index punched right back up to those highs, is stalling and just consolidating right up along there. What's your take on the dollar here?
Well, as you say, Patrick, we're consolidating right along a major resistance level, which is expected to provide resistance before you get through it. Looks to me like we're resisting until we eventually get through it, and when we do get through it, I wouldn't be surprised if the move higher accelerates from there. I don't see any reason to think that this dollar chart is about to reverse, but let's save the bulk of the dollar conversation for Brent Johnson. That's going to be the focus of today's interview.
Okay, let's touch on crude oil. We rolled to that October contract, and the moment we did, it broke to a fresh high of August anyway, and that descending trend line seems to have been broken. What do you make of this reversal higher in crude?
Well, Patrick, what really happened this week started with very bearish news. The story was that the Iran deal looked like it was about to happen. WTI was testing new lows, or on its way to new lows, on Monday morning because of that. And I wouldn't have been surprised, had the news not changed, if that move had accelerated even lower from there. Then Saudi Arabia came out and said, hey, of course, looks like Iran is coming online. That may bring new oil in the market, and therefore OPEC will need to cut production in order to compensate. Well, as soon as they said that, I think people kind of got the memo and realized, oh, it's not the case that as Iran comes back online, we're going to be flooded with oil. It's only going to add a little bit of spare capacity back into what OPEC Plus has control over. So I think that was really what changed the whole mood of the market, and maybe that did result in the bottom being put in. We'll have to see what happens, but it feels to me like the sentiment has changed considerably as a result of that comment out of Saudi Arabia. And we'll see what happens when the next bearish news hits the tape.
Erik, how did the inventory numbers come out this week?
Well, what we really had was an 11.4 million barrel drawdown, a massive, massive drawdown. That was disguised a little bit because 8.1 million barrels came out of the Strategic Petroleum Reserve, leaving the headline print in only 3.3 million barrels. But the real number was 11.4 million barrels total inventory drawn down from U.S. reserves. Cushing, Oklahoma, building 426,000 barrels. Gasoline drawing down a de minimis 27,000 barrels. Distillates drawing down 661,000 barrels. U.S. production ticking down another 100,000 barrels to 12 million barrels even. That's down 200,000 from the peak set just a few weeks ago. Tape action after the data came out was quite a tug of war. We were more than $1 down, then it was more than $1 up, then it was more than $1 down, then it was more than $1 up, as the market was trying to reconcile more and more signals of oncoming recession suggesting lower prices, and at the same time, a very tight physical market suggesting higher prices. I think maybe the tide is starting to change in terms of that sentiment. And Patrick, of course, as our longtime listeners know, I think that the sentiment should be much more bullish because I think that the world is out of spare capacity and we're eventually headed much higher in prices. But it's still possible we go down $10 before we go up $50 from here.
Erik, let's touch on gold. August saw a really solid bull reversal that from a very oversold condition. But just like that, gold is reversed right back down. What do you make of the current trends in gold?
Well, Patrick, I think this is make or break time for the gold market. We got the gap fill on the chart that I think was maybe helping to bring the price down. Was that the end of a healthy correction or pullback here, or are we seeing the beginning of a rollover toward new cycle lows below 1680? Time will tell, but I think we're coming up on the make or break spot.
This week's feature interview guest is Santiago Capital founder Brent Johnson. Erik, why did we get Brent on the show this week?
Well, Patrick, Brent has been one of our listeners' favorite guests over the years. We haven't had him on in, I think, over a year now, so we're long overdue. But particularly as the U.S. dollar has really started to appreciate, Brent's been very well known for his dollar milkshake theory, where he's anticipated that there would be more strength in the U.S. dollar than most analysts thought. Since it seems like he's being proven right, we wanted to get him back for another update.
Well, Erik's interview with Brent Johnson is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Brent Johnson, founder and chief investment officer for Santiago Capital. Brent prepared a slide deck to accompany today's interview. I strongly encourage you to download it as it contains quite a few graphs and charts that we'll be referencing throughout the interview. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com. Click the red button that says Looking for the Downloads just above Brent's picture. Brent, it's been way too long since we had you on the show. I think it's been over a year now. It's great to have you back. Let's talk about one of our favorite subjects, the U.S. dollar.
Yeah, it's great to be back. And it would be kind of funny if we didn't talk about the dollar here, especially with what's been going on this year. So I'm happy to be back and happy to talk to you.
Maybe we should start with a refresher for people who are not familiar with your dollar milkshake theory. A lot of people have been kind of confused by the U.S. dollar. They thought that the debasement of the currency by the Federal Reserve printing so much money and stimulus and so forth was going to cause the dollar to lose value, but it seems to strengthen when a lot of people thought it was going to go the opposite way. Give us a little bit of a refresher course on dollar milkshake theory and how you think about things and how we should be thinking about them.
Sure. Well, the best way to think about the dollar milkshake theory, because I think there is some misconception about it, is it's not just the dollar going higher. I mean, that's kind of the effect of the theory, but the theory is that we are going to enter a sovereign debt and a sovereign currency crisis. And the dollar milkshake theory is the framework via which I kind of see that process playing out. A couple of years ago, when the dollar was falling post-COVID, when they were, doing all different kinds of stimulus and monetary support, a number of people said, well, the theory has been invalidated. Now, over the last year, as the dollar has risen, a number of people have said, well, it is validated. And to be honest, what I would say, Eric, is neither of those is the case yet, because as of now, we have not really entered a sovereign debt or currency crisis. I still think one is coming, but as of now, I don't think you could either say it has worked or it hasn't worked as far as the theory itself. I think we're going to find out over the next couple of years whether or not it's valid or not. But as it is now, we've got a very strong dollar and we have the potential for some volatility into crisis. But as of yet, it has not yet really arrived.
Let's talk a little bit more about sovereign debt crises in general and what they mean. I think that there's a real trap here. At least I know it's been a trap for me personally earlier in my investing career. People who are prone to feeling frustrated by a lack of responsibility on the part of federal governments around the world tend to get frustrated and think, boy, we're headed toward a sovereign debt crisis. I've felt that way for more than a decade. I know you have. A lot of people have. What I think it tends to do is it causes people to immediately focus on their own currency and their own government's lack of responsibility. And they say, boy, with the things the Federal Reserve is doing, it has to be negative for the U.S. dollar in the long run. But what they fail to stop and consider, Brent, is it's not just the Fed that's doing this. It's all of the central banks around the world. And because the U.S. dollar index is relative to other currencies, it's not really a question of whether the dollar is going to lose absolute value. It's a question of whether it's going to lose relative value. So how do you think about that, and how should people think about it? Because on one hand, I think you're right that the dollar is going to appreciate against other currencies, but I don't think that means it's going to appreciate in absolute value. I think it's going to lose absolute value, but it's going to still probably be the cleanest dirty shirt in the pile. Is that right? And how should we think about this in terms of investments?
Yeah, I think that is right, Eric. And I think that is where many people perhaps have misconstrued or misunderstood my theory. For a long time, I've said we will get into a situation eventually where I believe we will see the dollar, gold, and the Dow all rising together. And the reason for that is, and what I mean by that is against all other currencies, right? And so, it doesn't mean that just because the dollar is going higher doesn't mean that you can't still have inflation. Just because the dollar is going higher doesn't mean that you can't still have asset prices rising. Now, a lot of times that doesn't happen, and I actually have some slides to kind of highlight that. But to your point, if all fiat gets debased, but the dollar gets debased less than everything else, you can still see asset prices rising. But I also want to highlight that just because all fiat's being debased, and even though the dollar's being debased as well, does not mean, and I caution investors here, it does not mean that you can just ignore the relative strength of the dollar. The relative strength of the dollar versus other fiat currencies, even if everything's being debased, has enormous impacts on global capital markets. And I would urge people to kind of understand this.
Brent, let's get into your slide deck, starting on page 2. You're showing the trend here over the last few years. And boy, at a time when definitely we have been stimulating and printing money and doing all kinds of things that people predicted would result in a loss of value of the U.S. dollar, it's been steadily appreciating. What's going on here?
Well, essentially, this is kind of what I've tried to get people to kind of think about over the last couple of years. And I've even said on several occasions, the more the Fed prints, the higher the dollar is ultimately going to go. And again, the reason is because the dollar here, the DXY index, currencies trade relative to each other. To your point a minute ago, I think part of the reason that many people in the US have a hard time focusing on relative currency levels is because they've never had to do it. And the reason they've never had to do it is they have grown up in a country that had the global reserve currency, in which case, global markets use the dollar. So we've never had to really think in two different currency terms. If you talk to many people outside the United States, they are very used to thinking in two different currency terms. They're used to thinking in their local currency, and then they're used to thinking in dollar terms. And what I'm showing here is, when I was here last, the dollar was at 92. And, last year, I felt like there was a bull market uncertainty, and everybody was just absolutely certain that the Fed could never stop QE, they could never raise rates, and they could never, do any tightening of monetary policy. And yet here we are a year later, and they've stopped stimulus, they've raised rates, they've sort of embarked on QT. We'll see if they actually follow through or not. But the dollar is at 109, and just many people just thought this was not possible. And I think I would just use this as an opportunity to say, listen, don't ever be certain about anything. The world is kind of a crazy place, and very, very strange things can happen. And you need to start thinking in a couple different currency terms rather than just in dollar terms. In fact, if you look at the next slide, Erik, the dollar has not only survived the massive stimulus, money printing, helicopter money, however you want to describe, the programs of the last 10, 12 years. The dollar is actually at the same level it was 20 years ago now. And by all accounts, it's very possible that it continues to go higher. Now, whether it will or not, that's to be determined. But the point is not only has the dollar not collapsed, but it's at its strongest point in 2 decades.
Let's talk about where it is headed. Is this trend going to continue? And if so, what would change it, or what do we need to worry about that potentially changes the equation?
Well, so, about a month ago, we hit 109 level. We pulled back a little bit. And now, over the last day or two, we've kind of been right back up at this 109 level again. And, I've seen a bunch of people saying, oh, here's the double top and, that's it. Well, maybe it is, Erik. I don't know for sure. Maybe, Powell will be dovish in his speech on Friday, and maybe the Fed will back off a little bit on their monetary policy and the dollar will pull back for a month or so. But the point I would make is think of all the things that they have done, not just over the last 2 years, but over the last 12 years. And despite all of those attempts to keep the dollar under control and keep it down, here we are at 20-year highs. So I don't know the exact timing of the dollar going higher. I tend to think that it's going to be higher at the end of the year than it is now. None of this is for certain, but the point is if everything they did over the last 2 years didn't keep it down, what are they going to do with the very high inflationary prints that we're getting now, to get it down over the next 6 months? And I think it's not an easy answer. And part of the reason is because we are not the only ones. And when I say we, I'm referring to the United States. The United States is not the only one that are committing these financial sins, right? You've got the ECB and the BOJ who are just in really, really tough spots. And I put a couple slides together on this. If you look at slide 5, Erik, it shows the massive increase of the balance sheet of the Fed over the last couple of years. But when you look at it compared to the ECB, and when you look at it compared to the Bank of Japan, you just realize that we're not alone in this madness, right? And these other two countries are having a very, very hard time right now. And the thing I would say is, a lot of the people that I speak to, and to your point from earlier, that think that we're going to have this sovereign debt crisis, we're going to have a currency crisis, the dollar is finally going to lose value because we've been fiscally profligate and we're just printing money. All of those are valid concerns. But what I would say is everything that everybody is worried that will one day happen to the dollar is already happening right now today to the euro and the yen. And it's reflected in their charts. If you look at the charts on I think they're page 7 and 8. These are very long-term charts, and they are very ugly. These are the charts that everybody thinks that eventually is going to happen to the dollar. And perhaps it will happen to the dollar. But again, It is already happening to the euro and the yen. And I'm not sure how Japan or Europe comes back from this. So sure, can they get a dead cat bounce? Sure. Can they get a temporary few months of some strength? Of course, that's possible. But what are they going to do to solve their problems? And again, it's a really tough situation, and it's because of everybody's kind of in the same situation now that I think we're going to finally have this crisis.
Well, let's talk about the crisis that we're going to have and how it differs from the crisis that so many people have assumed we were going to have, because lots and lots of people have seen the reckless, profligate spending behavior of governments and said, okay, this is crazy. We're eventually going to get to some kind of sovereign debt crisis where governments just spend beyond their means for too long and everything blows up. Most people thought that meant dollar crashing, and you've just explained why actually what it means is dollar outperforming on a relative basis versus the other countries that are being even more reckless and even more irresponsible in their borrowing and spending. So if that continues, does that mean that dollar continues to appreciate versus those other currencies? At some point, does the dollar hit a crescendo and it's a blow off top and it all reverses? Or does the dollar stay super strong throughout this entire crisis because it's those other currencies that are failing first?
The way I see it playing out, Eric, I do think there will be a crescendo, but I think that crescendo, I think it's going to take a lot longer than people think. I think it could easily take a couple of years, and maybe it takes 5 or 6 years. Now, you kind of have to be, in my opinion, you kind of have to be ready for it to play out over the next 6 months, but I just don't think it's going to. I think it's going to take several years to do this. And as a result, I don't think we're just going to see a straight line where the dollar goes higher. I do think it's very possible that over the next, let's call it 2, 3, 4 years, maybe 5 years, the dollar in general stays higher than it is now, but I don't think it will just do a steady march higher. I think there will be periods of time where it makes a run. Maybe it'll run to 120, Eric, and that'll cause all kinds of problems. And so the monetary authorities of the central banks will come out and do something, and maybe the dollar pulls back to the kind of this area, the 105 to 110 area. And then, it makes another run to 130 and then causes all kind of problems. And then that pulls back to 120. And then, so I think we're going to see this kind of start and stop because I don't expect monetary authorities just to sit back and let it happen. But I do kind of feel like, we're going to get into the situation where the dollar eventually gets away from the monetary authorities. One thing I should say, Eric, which I am of the opinion, is that while dollar strength causes all kinds of problems in the monetary system, which I've been trying to highlight over the last several years, and the Fed does not want a runaway dollar, I actually think that the Fed is happy to have a strong dollar right now. And I think that they have been raising rates kind of in conjunction with wishes from the Treasury Department to get the dollar stronger. And I think they are using the dollar. When I say they, I mean the U.S. government. I think the U.S. government is using the dollar as a geopolitical weapon, a tool, for lack of a better word, in order to kind of bring some countries to heel, put other countries in a vulnerable position. I think it's fair to say over the last couple of years, post-COVID, when everybody was cooperating, that now we've seen kind of a bifurcation. We've got East versus West, China versus the U.S., Russia versus the U.S., Russia versus Europe. So new alliances are kind of being formed, sides are being drawn, lines are being drawn. And I think each side is trying to shore up their team. And I think by putting, some countries in vulnerable positions, the U.S. can then extract some favors from those countries, or maybe they help them with dollar funding, but in exchange there's some strings attached. And not only that, but the strong dollar puts enormous pressure on both Russia and China. So I don't think that this dollar strength is an accident, but I do think that we will eventually get into a place where the dollar gets away from the Fed and gets so strong that it will have this crescendo that you mentioned. And at that point, I think what's going to happen is some kind of a reset. Now, whether it's done, the U.S. resets it on its own, or whether it's some kind of a coordinated thing that everybody agrees to, I don't know. But I just know that without redesigning the system, without resetting the whole system, no matter whether it takes 6 months or a year or 2 years, even if the dollar falls short term, we will get back to a point where we're at, like we're now, where the dollar is just strong due to all the dollar debt and all the dollar demand in the world.
Brent, a lot of people talk about the dollar index as if it were a measure of absolute value, and of course it's actually relative to other currencies. Let's go into a little bit more detail on the major currencies in the basket, which are the euro and the yen. You've got a chart on page 7. It really looks like the euro has already broken down on a technical basis to a level that suggests to me that looks like it's headed back toward a retest of those lows from 20 years ago in the mid 80s. Is that right?
Yeah, I mean, I kind of jokingly say that the euro is about 100 points higher than my than my ultimate price target. I just don't see how the euro recovers. I just really don't. I think it's going to at least 80 cents, and it's very possibly going lower than that. And the yen is kind of in a similar situation, Erik. Again, many people have talked about the fact that at some point, the rest of the world is no longer going to finance the U.S. government's debt. And when that happens, the Fed will have to buy it all. Rates can't go higher because then it will bankrupt the United States. Well, that is exactly what's happening in Japan right now. If you look at page 8 in the chart of the euro, this is a result of that happening in Japan right now. Japan has a massive amount of debt. They've been issuing, they've had interest rates at zero or negative for decades. A decade at least, and they've issued a lot of debt at those low rates. And so as a result, a lot of pension funds and retirement plans and banks and insurance companies in Japan are loaded to the gills with zero yielding JGBs. Now, if interest rates rise even a little bit, which they started to do earlier this year as a result of all the inflationary pressures, it very quickly causes a banking system crisis in Japan. And so the Bank of Japan has had to come out on several occasions and just do these enormous bond buying programs, buying the bonds to keep the interest rates low. And as a result, flooding the market with yen. And as a result, the yen is down like 15%, 20% in the last year. That is an incredibly big move for a major currency. It would be a big move for an emerging market currency. But for the yen, which you could argue is the second or third most important currency in the world, to drop that much in a year, it's really quite something. And again, it's a result of all the things that many people think will eventually happen to the dollar. So again, you can live in the future or you can live in the right here and now. And I know many people future trip about what's going to happen to the dollar, but the yen is experiencing it today.
Well, Brent, it seems to me that the stage geopolitically has been set for the euro particularly to continue to suffer, because as much as this conflict with Russia is hurting a lot of different countries, boy, the energy crunch that it's putting on Europe has just been crazy. What do you think this means in terms of the setup for what's coming next? It seems to me that more escalation of tension between Russia and the West is likely to happen here. What does that mean in terms of the dollar and particularly in terms of the euro?
Well, I really think, Erik, this is kind of why I think that the dollar hitting 109 again, and a couple of people calling for a double top. I just don't think it's right. I think we're going to go through 109. I think we're going to end up going higher, and the reason is really what you just laid out. I mean, a month ago, the ECB raised rates to zero, from negative to zero, their first rate hike in over 10 years. And on the same day, they announced a new bond buying program to hold rates lower because, Italy and some of the southern countries are already starting to see their sovereign bonds fall in value. And so this is before we've even gotten into the winter, when, the energy crisis is really going to, the rubber's really going to hit the road. And I can just imagine how many euros are going to have to be printed to subsidize the energy needs of the Eurozone. I don't think Putin did this to cut him some slack come, November or December. I think he did this very strategically in a way to put them under maximum pain. And, fingers crossed, maybe, by some miracle, we can come to some agreement over the next couple of months and all this crisis is averted. But I think the probabilities of that are pretty low. And so, the euro's at 99 right now. It wouldn't surprise me if the euro's at 95 in a couple of weeks. And it wouldn't surprise me if it's in the high 80s, come this winter. Again, when you think about what they would have to do to turn that around, It's just really hard to come up with a way for it to happen. Now, is it possible? Of course, anything is possible. I think you kind of have to be ready for anything in this type of an environment. But the odds that are stacked against the euro right now are really rather, I guess, immense is the best word I can come up with.
Brent, I think it's so important that we be really clear on this subject of absolute versus relative performance when we talk about currency indices like the dollar index. Please elaborate.
Yeah, so one of the arguments that I often get, Eric, is because if we're in this environment where there's inflation all over the place, and even though the dollar is rising versus other currencies, it may be falling in absolute terms. I think it's really important because, a lot of people have said to me, the only reason the DXY is higher is because it's tracking the euro and the yen, and the euro and the yen are the only ones that are losing value. Well, that's not the case. There's a slide here that shows that against most currencies in the world, the dollar is up, and not only up, but up significantly. And the argument that I get is that since all fiat currencies are being devalued, I don't need to worry about the relative strength of the U.S. dollar. And I kind of jokingly put a facepalm emoji in here. It's because I really want people to understand this. That is you unless you're going to go move away, live on a mountaintop, and not engage in society. That is just unfortunately not the case. It would be nice if it was that easy, but it's not. And the reason is because the world operates on dollars. So in most transactions and most asset prices traded around the world, the dollar is the denominator, and the price is then the numerator, right? The problem is if the denominator starts to grow and grow fast, that by definition mathematically means the price, which is the numerator, falls in value. Now, that wouldn't be such a bad thing if there wasn't so much dollar-based debt and there wasn't so much leverage in the world. But as those prices start to fall, and even if it's just something that you don't personally use, in a debt-based monetary system, it can lead to a default. And once one default starts, then another default starts, and it has the potential to be a daisy chain. And if there's any doubt about this, just go back and look at asset prices in March of 2020. Everything went down because the dollar was going higher. Wheat went down, gold went down, Bitcoin went down, stocks went down, bonds went down, real estate went down. There was no place to hide, and it was because the entire monetary system is priced in dollars. And so you really do not have the opportunity to just ignore fiat. It's a nice thought, but it just doesn't really work that way. And I threw a few slides in here for people to look at it. If there's any doubts about this, I threw some slides from 2022, 2020, back during the dot-com bust and during the global financial crisis. And it just, what it basically shows, Eric, is when the dollar is rising, asset prices tend to fall. Now, this is not always the case. Of course, there are exceptions. But when you get a rapidly appreciating dollar, typically asset prices fall. And, you don't have to bet on that happening, but I would be very careful against betting everything that it isn't going to happen. And so, a rising dollar, unfortunately, if you're going to be involved in global markets, I think a rising dollar is one of the most important things that you can understand.
Brent, I want to interrupt and ask about gold here because it seems to me that, the very, very common gold bug strategy was people got the idea that fiat currency in general was being debased. That had to be good for gold. What happened, though, was other currencies got debased a lot faster than the dollar. So investors who are euro-based or yen-based investors who bought gold are absolutely delighted right now. The performance has been fantastic. But people whose investments are denominated in U.S. dollars who bought gold on that logic have been disappointed because even though gold is doing fantastic against fiat currencies, the dollar is outperforming other fiat currencies, and it's making gold investments denominated in dollars not look so great. So how do we reconcile all this if your view is still that governments all around the world will continue to debase fiat currencies? And you kind of thought gold was the way to play that. Is it the right way to play it if you're a U.S. dollar investor?
Well, I think there's two ways to answer that, Eric, or it's a two-part answer. And the first thing I'd say is, despite my short-term views on gold, I am still a believer that gold is one of the most, if not the most important asset that you can own in your portfolio. I believe that the reason you have a portfolio and that you have diversification is so that not all assets in your portfolio are performing the exact same way at the exact same time. I do believe that there will come a day where gold will be the savior of your portfolio. In dollar terms, I don't think that day is today. So I do think we will end up there. I think it's important to own gold, but in the short term, I think gold has some challenges as well. I have a slide in here somewhere where we basically show that, it kind of had this double top. It hit 2000 in 2020. It came up and tested it again this year. And now it has kind of rejected the downslope 2 different times. And we're kind of approaching a fairly important level. Let's call it at the, 1670 to 1690 range. I think it's very important that level holds. If that level were to give way, I would expect gold to fall, 1500 or something like that. But again, just because in the short term, I would view that as an opportunity to then buy gold. And just because I think that the price is going to potentially fall in the short term, it doesn't mean that I think you should go out and sell your gold. It doesn't mean I think that you should ignore gold, and it doesn't mean that you shouldn't still hold it in your portfolio. I'm just not expecting it to pay off right now. The other thing I would say is, part of the reason it's not paying off right now, Erik, and you kind of alluded to this a minute ago, is that the US dollar is not in a crisis. Now, you may think it should be in a crisis. You may want it to be in the crisis. But it's not. I'm sorry, it's not. It's at a 20-year high, which means, there's more faith in the dollar today than there was 20 years ago on a relative basis to the other choices. And again, relative matters. I know a lot of people don't want to think that relative matters, but it really does. And the other part of this, Erik, is I think one thing investors need to really try to do is not so much consider what they think about something, but consider what most of the other people that are operating in the markets think, right? Most of the other people in the markets do not wake up every morning and go check the price of gold. Most of them check the price of the currency or the interest rates or the stock market. At some point, that will change. And when that happens, I think gold will do very well. I just don't think we're there yet.
Well, Brent, you've said that gold is longer term an asset that you favor, but maybe not so excited about it right now. What do you get excited about in this environment? Let's talk about where the trades are, what the portfolio construction should look like based on the way you interpret the landscape here. Why don't we move on to, I think, page 23. You've got several slides on this.
Yeah, so my overall asset allocation hasn't really changed a whole lot in the last year, Erik. We're still positioned pretty similarly. We've made some money over the last year. I wouldn't say that we've hit a home run over the last year, but we've made some money. We're set up in a way that we're kind of ready for anything. But what I think is interesting is to kind of, even though we're still positioned pretty similar to last year, I think it's interesting to kind of take a look and see how things have changed over the last year. When I was here a year ago, the 10-year treasury yield was still within this, call it 30, 40-year channel. Since that time, it has broken out to the upside. It broke through it pretty significantly. It came back and kind of touched the top of that channel, sometime over the last month, and now has started to bounce again. I actually think that it's likely that the U.S. yields will fall and re-enter this channel. But what I would say is I don't currently have this trade on, and this is not a trade that I feel super strongly about. A lot of people assume that because I think the dollar is going to get a lot stronger, that it's a deflationary environment, and therefore bonds have to get stronger. And that could happen, again, and that's why I think it's very possible that these yields come back down, but it's not necessary. And if you think about it, the fact that yields are up is one of the reasons that the dollar is so strong. You can actually buy a U.S. Treasury now and actually get a little bit of yield on it. Over the last several years, how many times do we talk about you can't buy anything and get any yield? Well, now you can buy a 10-year bond and you can get 3% on it, which is not great, but it's about 3% more than you could get a couple of years ago, right? And so, yields being higher does certainly not hurt my thesis at all. The other thing that I think is really interesting right now is equities. When I was here last fall, I was saying that I was expecting that we would get a pullback to the top of this very long-term channel that I've been tracking. And I thought it was actually going to happen in Q4 of last year. Turned out it didn't happen until this year. So I was early, but it did pull back. And it's kind of amazing. It pulled back right to the top of that channel. And then it's had a very strong bounce since then. I would say that this bear market rally, I'm calling it a bear market rally. Whether it turns out to be or not, we will see. but it's my belief that we're in a bear market rally. And I think it's very possible we pull back into the kind of the middle of that channel before we then make a move back to, I still think over the next couple of years, when we get into this sovereign debt crisis and as investors decide to get out of sovereign bonds, all that money is going to have to go somewhere. And I think that money will find its way into the US dollar and the US equity market. So I still think that despite some pain that I think we're going to have over the next 6 to 12 months, I think after that, I think we could have a very strong move higher in equities.
Let's move on to commodity markets. You've got a slide on page 24. Let's talk more about this.
Yeah, well, this is something else that I talked about last year, and I mentioned that I thought that we were, the commodities were threatening to break out of this, this band that they'd kind of been in for a while, and I kind of noticed that it was kind of shaping up to be this very, very long-term head and shoulders pattern. And sure enough, I was much more bullish on agricultural and kind of soft commodities than I was on kind of base metals or industrial commodities. Now, it turns out we saw kind of a big jump in all of those, and it's kind of amazing. It went right up and kind of tested, the kind of that right shoulder. And we've had a pretty big pullback here in commodities over the last, 3 to 6 months, depending on, which ones you're looking at. I think we're in a very, very uncertain time right now. I think with markets the way they are, with the Fed continuing to tighten, I really don't know what's going to happen, Erik. I know people would probably like for me to come on here and be very definitive. And the simple answer is I don't know. What I do think is that I don't think you can ignore the inflationary pressures, and I don't think that you can ignore the deflationary pressures. And which side of the razor's edge we're going to fall, I just don't know. But I ultimately think that we will get into a commodity bull market. Whether it happens this year or a year from now, I'm not sure. But I think once we kind of break through that level that we saw earlier this year on commodities, then we will probably be off to kind of the races on commodities. But it's a tough call right now.
Brent, with respect to commodities, obviously there was a huge run-up in commodities as there was kind of the reopening spike, if you will, then maybe it's kind of sold off as we're realizing that maybe we're headed into a global recession. What's the direction from here, and what are the things that could happen to change the direction in terms of your outlook for commodities generally over the next couple of years?
Well, yeah, I think the markets are just very, very interesting right now because I do think we're kind of on this razor's edge between inflation and deflation. I lean towards deflation, but I always say be ready for anything. What I think is interesting right now, Erik, is what we are seeing with the dollar, with the yen, with the euro, and how this really affects China. Because China is probably the one thing that we haven't spoken about yet that is maybe the most important, variable in the markets. China has had the economic global engine of growth for a few decades now, and they are struggling mightily with both the deflationary pressures of their real estate market. The Chinese real estate market is probably the biggest asset class in the world, tens of trillions of dollars big. But now it is no longer growing, and you could argue it's falling. And so China is really, really having or they're really struggling with the deflationary pressures of this, despite, they have high inflationary costs because they have to import a lot of food. They have to import a lot of energy. They have to import water. And with those being priced higher right now, they're really getting squeezed from both the top end and the bottom end. And they have had to ease monetary conditions over the last couple of months to try to fight this deflationary pressure. What is exacerbating it, Erik, is not only the increase of commodity prices, energy, food, et cetera, but the fact of what's going on with the yen is dramatically affecting them as well. We showed that chart of the yen earlier where the yen has fallen like 15-20% in a year. That's important, not just on the global stage, but it's important regionally because the yen or Japan and China and the yuan kind of compete with each other regionally. And as Japanese goods get more inexpensive due to the falling yen, it makes them more competitive with Chinese goods. And so, if you were to look back over the last 10 years of the yuan, and you saw in 2013, it had a little bit of a deval. And then in 2015, the more kind of famous mini deval, because they have a pegged currency, and so when it dramatically eases, that's by design. That's not kind of by accident. But they had to. If you look back at those two occasions where that happened in 2013 and 2015, each of them were preceded by the yen weakening. And that's exactly what happened again this year, Eric. In the first quarter and second quarter, as the yen was dramatically weakening, the yuan was staying fairly strong. But then in the last couple of months, you've seen the yuan start to weaken appreciably. And it's because of this dynamic that of not only the stronger dollar, high energy costs, and the weaker yen are putting them in a very vulnerable position. And so I think ultimately what is likely to happen is that I think China will ultimately have to devalue the yuan, because I just don't think there's any other way for them. And when that happens, I think that will send a deflationary wave out of China, pull an inflationary wave into China, and that deflationary wave out of China to the rest of the world probably pushes the dollar higher. And we all know, as we've just been talking about, the problems that a higher dollar causes. And I think it's something like that that could then lead to a rapidly appreciating dollar, that, the central banks kind of have to come out in coordination and, stop its runaway ascent, so to speak. And whether we get, a temporary solution to dollar strength at that point, or we get an overall reset, I don't know. But I think we are getting closer to this quote unquote end game that many people have spoken about for years now. It is amazing, the government's and the monetary authorities' ability to kick the can down the road. And I'm not going to sit here and say that they can't do it again. But I think the further we go forward in time, these kind of end-game scenarios become a higher probability event. And I just don't think they can be ignored anymore.
Well, I agree, Brent, and I think what's going to happen in the case of currencies is that the digital currency system that can replace the U.S. dollar as the world's global reserve currency doesn't exist yet, but it will someday. And to me, it's all a question of how someday happens from here. What is the path to get there going to be? I think it's unlikely that an existing cryptocurrency like Bitcoin will be that be-all, end-all global reserve currency system. But we will get some kind of digital currency to replace the dollar as the world's global reserve currency. When that happens, I think it's going to be a game changer for the entire world. And I think this is the decade it's going to happen in. Any thoughts on that?
Yeah, I tend to agree with you, Eric. I don't know. I tend to agree that we will have a digital solution. I tend to agree that this solution will be government-based rather than private market-based. It doesn't mean that Bitcoin is going to zero, but the Bitcoin maxis who think that governments around the world are going to, end up bowing down to this private currency, I think it's just wrong. Perhaps it's a nice thought, but I just don't see that happening. But, this private market solution opened up the eyes of a number of governments around the world to the power of them. And, it's kind of one of these genies that's out of the bottle now. And the idea that it's going back into the bottle, never to be seen again, I think would be very naive to think that. So I tend to agree with your assessment there.
Brent, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners a little bit more about what you do at Santiago Capital, how they can follow your work.
Sure. Well, I have an SEC registered and an NFA registered firm. I do overall wealth management for, a very small group of very wealthy individuals. And we do kind of complete wealth management solutions for them. As part of that solution, we also manage private funds, and we have it's a very specific. It's kind of a volatility focused fund that we think will do well if this crisis that we have long predicted ever plays out. We use that as a hedge against the traditional portfolio, and we have a number of clients who are involved in that private fund who do not use our services for their overall wealth management. But if anybody would like to contact me to find out more, if you go to santiagocapital.com, you'll find my contact information on there. You can call me or email me. And, I will say I always try to get back to as many people as I can. Our services are limited to very high net worth and accredited qualified purchasers. And so I cannot always, offer a solution to everybody. But anybody that wants to reach out, I'm happy to try to help to the extent I can do so.
Patrick Ceresna and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. Mail order Viagra salesmen need not apply. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Brent back on the show. It is interesting that his view all along was the idea that the stresses on the system would be actually from a rising dollar, not a falling dollar. And that really seems to have materialized, particularly over the last year. What was interesting is his thought that we could enter a period where the U.S. dollar could continue to rise and potentially commodities are rising in that environment, which is not a natural intermarket correlation. It'll be really interesting to see whether that dynamic starts to emerge in the back half of the year.
Well, Patrick, let's get on to our very natural post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, page 2, S&P 500, what are we looking at here? Is it turning around?
Well, I just put on that 50-day moving average because it seems to have been a pretty good arbiter of trend. And we had such a strong rally that it diverged away. And now this pullback has brought the market right back down to that 50-day moving average. I also drew a red line of where the 50% retracement lies, which conveniently is right around that round number of 4,000. And the way that I kind of look at this chart is that even if we did temporarily break to 4,000 and poke below the 50-day moving average, if this was just a correction in a new rally, we should see the bulls use any weakness down into that area as a buying opportunity, and we should see the bulls quickly turning up the chart out of there. It would be a sustained breakdown below those levels where I feel that there would be the real signs of technical damage that could really start to drive selling, where we could see volatility start to rise up again and see the natural feedback loop that comes into weakness that creates that big downside volatility. I don't think that's here yet, but we're slowly approaching kind of the line in the sand areas where the bulls will really have to hold the line. So it's certainly something to watch into next week.
Speaking of lines in the sand, a lot of dollar bears have said that 109 or 110 would be a red line in the sand that the dollar couldn't move above. What do you think of this chart on page 3?
Well, I want to look at page 3 and 4 together, where I have the Euro USD on there. And let's just first put context of page 4, which the Euro has broken to a lower low. And more importantly, that lower low was from parity. And so we've now actually seen for the first time in decades that euro across this kind of parity Rubicon. And while the dollar has not made necessarily higher highs, maybe it's because the yen hasn't yet been able to make that big burst. The entire currency markets, cross currencies are all very, very weak. And the US dollar remains the dominant trend right across the entire cross-currency spectrum. And, if for whatever reason this was a top. There is no indication of it yet. At this moment, respecting the dominant prevailing trend is the only reasonable proposition at this stage. And while it obviously has a huge psychological bearing, and a lot of people talking about whether the euro should be bought at these levels, at this moment, it would not be a shocker for me to see another 2-3 cents trimmed off of the euro as it goes to 96 or 97 cents on the downside. At some point, it's going to get oversold enough where it's going to turn, but I don't think that moment is here yet. With that said, Erik, let's move on to crude oil. And I have that chart on page 5 and really showing an interesting pattern, which is when we broke down here in August, we broke to a lower low, but just temporarily, almost like just anyone that had stop losses just sitting below a previous low just to get nicked or something. But what's interesting is that the reversal has been strong enough to now make a higher high. And so we have this pattern that over the months of June and July, oil was perpetually making lower highs, lower lows, and a very pronounced downtrend. And we're for the first time seeing signs that at least some sort of a base is in. To me, it's going to be all about clearing some key hurdles. If crude oil can make its way back towards 100 and then not make lower lows where the price action really starts to show signs of accumulation, it might be a sign that this 2+ month correction in crude oil, which was more or less about a 50% retracement of the entire year rally, it might be turning up. And that's certainly something to watch, because I think that overall your bull narrative is bang on. It's about just identifying when technically the trend has shifted. And maybe these are the first signs right before we start seeing more bullish price action.
Well, Patrick, I agree completely, and of course it's also data dependent. What we were looking at this week, although you can barely see it on that sort of doji-looking candle there from Monday on your chart, is it was looking over the edge of the abyss and about to just drop farther as the Iran nuclear deal came together, and then the trend reversed in an instant on the Saudi statement that this would mean OPEC might need to cut production in order to compensate. So, let's wait till there's the next news event to come out and reverse the tape hard in the other direction and see whether or not we can resist another lower low. I think the market probably can, but that's going to be the test, is when some bearish news hits the tape, pushes us down to a lower number, is it lower than the low that's already been put in back in August? And I think that's the big test that's coming up.
Now, page 6, I have the energy stock ETF, the XLE. And what I wanted to do is just give my interpretation. And since you know this market a little bit better than I do, you can tell me whether you think my thought exercise is on the right track. But what we obviously have seen is a pretty significant correction at the front of the curve of crude, where on the term structure, those front month spot prices, where we saw the correction. But it's led to relatively just simply a flattening of the backwardation. But overall, when you go farther out, oil has not really dynamically changed outside of the front of the curve. And really, when you talk about energy stocks, they tend to price oil into the future as opposed to just trading based on spot. And one of the interesting elements is that these energy stocks have actually already started to bull. They've already been running. They've didn't care that crude oil was stuck in the mud or even making lower lows. They just started to accumulate. And even during this entire stock market pullback over the last week, energy stocks just kept making higher highs. There is some clear bullish price action. And obviously, Warren Buffett contributed this as he took a larger stake in OXY, which has had a large number of copycats going into this entire space. But certainly energy stocks seem to be getting some pretty good tailwind here.
Well, Patrick, I trade the commodity, not the stocks, so I don't really have a viewpoint on the energy stocks, but it doesn't surprise me they're starting to perform, and that certainly stands as further evidence of the turnaround that we seem to be seeing in the actual crude oil chart. Let's move on to uranium on page 7. What is going on with that gigantic candle, it looks like 2 days ago?
There was that announcement that Japan is firing up its nuclear plants again, and certainly was used as a huge sentiment shift for the uranium market, which was stuck in the mud. When you look at the entire space of energy in terms of coal and natural gas and oil, so many of these markets have been doing so well, and it was really there was uranium that was stuck in the mud throughout this entire period. And this news lit the match underneath and has brought it back to life. One day doesn't make a new trend, but it's going to be really interesting to see whether the bulls can build on this. And it wasn't just uranium. In this case, I'm using that Sprott Physical Uranium Trust as for the chart, but also uranium stocks using that Uranium Miners ETF, URNM, which also, after consolidating, creating a right shoulder, it also bullishly broke out. A very early breakout. One day doesn't make a new trend, but it's certainly on my radar to see whether or not uranium gets things going here.
Patrick, let's move on to page 9 and natural gas futures.
Yeah, well, here we have a market that's been bulling for all of July and August, and it really it is attempting to break to new highs. I mean, not only did we approach $10, but we broke to higher highs in the sequence. Now, it did pause here, but still, this trend is very clearly still bullish, and there is no evidence whatsoever here that this is already topped or reversed. It'll be really interesting to see whether nat gas can work its way up to $11 plus on this push. It has been one of the far more bullish markets out there.
Listeners, if you enjoy Patrick's chart decks, be sure to check out pages 10 and 11 in the chart deck, where you can find information on a free trial of Big Picture Trading, Patrick's trading service. Or you can just go to bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what's in this week's Research Roundup.
Well, this week, you're going to find the transcript for today's interview, as well as a link to Brent's slide deck, as well as the chart book we just discussed here in the Postgame. There's also a number of links to articles that we found interesting, so you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account, @MacroVoices, for all the most recent updates and releases. You can also follow me at Patrick Ceresna. On behalf of Erik, Townsend, and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.